Thank you for everybody. Thank you for everybody who's joined in. Good to see new people join in. Good to see the old people join in as well. Uh, let me share my screen just a second. All right. I hope everybody can see my screen just to confirm.
Yes, we can.
Okay, perfect. Yeah. All right, perfect. So, well, this is the last session. This is the final session. We're not going to talk more about technical analysis because the previous sessions, the previous 5 sessions were a lot more into technical analysis, understanding different charts, understanding patterns, understanding how the markets move, what moves the markets, how does the money flow. So it was a lot of information on technical analysis on chart readings. This session is going to be a little bit different. It is going to be more on different types of assets that you can trade in the financial world. How are each and every asset different from one another? And we could also touch base on trading psychology. Trading psychology is very important. So we're going to look at trading psychology as well. Let us do a little bit of a recap of the previous session first, and then we can move on to newer topics as what we have been doing for the past 5 sessions. It's more of a ritual that we first do a little bit of a recap of the previous topics. So every we are sort of fresh. The topics we will be looking at today will be trends. So this is the recap of trends, what trends are, how are trends formed, so on and so forth, right? So what are trends? Trends are nothing but direction of the markets. This is how the markets move in a direction. There are trends are formed using impulse wave and corrective wave. There are two types of wave how trends are usually formed, an impulse wave and a corrective wave. This is an impulse, this is a corrective, impulse, corrective, impulse, and so on and so forth. The longer wave is usually the impulse wave. So if you see any long wave in the direction of the market, it is always going to be the impulse wave. And the shorter wave against the main direction is the corrective wave, so on and so forth. Uh, we looked at classification of trends. There are three kinds of trends: uptrend, downtrend, and consolidation. Uptrend is when price forms higher highs and higher lows. Look for buying opportunity. So when the markets are moving in an uptrend, this is how it is going to move. Impulse, corrective, impulse, corrective, impulse. Whereas higher high is your resistance level. This is your resistance level. And higher low are your support levels. So these are your support levels. And this is how the formation of an uptrend happens. How does downtrend happen? Downtrend moves in series of lower lows and lower highs. Uh, look for selling opportunity or shorting opportunity. This is how the trends form: impulse, corrective, impulse, corrective, impulse. Lower lows, lower high. Lower high is the resistance level, and lower low is the support level. And when the price is consolidating, what is consolidation? Consolidation is sideways momentum. So sideways, let's say sideways. We cannot say the price is in a momentum because momentum is when the price is moving in a particular direction, and volatility is when the markets are moving sideways. So consolidation is sideways. Markets are moving sideways. Buyers and sellers are equal, means there are equal number of buyers and sellers. That is why the price moves. So sideways, avoid avoid trading the markets when the markets are moving sideways. There is no clear direction. This is how the price moves, which means there is no clear direction in the markets. Let's look at let's look at the final topic to recap. That is change in trends. This is what we looked at in the previous session, but I just wanted to do a quick overview of the bigger topic of trends. Change in trends, there are two kinds of change in trends, uptrend to a downtrend and downtrend to an uptrend. These are the two types of change in trends. As the price is creating higher highs and higher lows, to a point where the price creates equal highs and equal lows, price starts to consolidate, price breaks the support level, and now we have a downtrend. Now we have a downtrend, meaning I'm trying to change the color for this. Oh, there we go. Meaning this is your support level. This is your support level. This is the resistance level. This is sideways momentum. Or sorry, not momentum. This is sideways market where the markets are moving sideways. This is an uptrend. Price creates higher highs, higher lows, starts to move sideways. This particular pattern indicates that the buyers and sellers are equal in the markets. Price breaks the support level, sort of creating a momentum on to the downside, which is lower lows and lower highs. So this is where the change in trend happens from this exact point in time and not from the top. It happens when the support level has been broken. So there is a break of the support level, retest higher, lower high, a lower low is being formed, and then this is a change in trend from an uptrend to a downtrend. Let's look at how a change in trend happens from a downtrend to an uptrend. The markets are pushing down, creating lower lows and lower highs. Price starts to consolidate, breaks above the resistance point, comes back down, changing trend. Let me explain this, how this has happened. This was a downtrend. Price was creating lower lows and lower highs. This was consolidation. This was an uptrend. This is when the market started to push up. When price was creating equal lows and equal highs, this is where we want to stay away from the markets. As the price breaks above the lower high or also your resistance level, price breaks through, which means buyers are in control of the markets. As the buyers take over, as the buyers are in control of the markets, what happens? An uptrend starts. This is when an uptrend starts, and as the uptrend is going, I'm sorry, I think I lost. Are you able to see my screen, Mr. Bilal? Okay, I think my screen is on. Okay, sorry.
Yes,
As
I
the
can
price
I can
is
see that screen. Yeah, we can see that.
okay, thanks. As the price is consolidating, the buyers take control of the markets, and this is the beginning of an uptrend. This is where the price starts to create higher highs and higher lows. This is how the market sort of move in a particular direction. Any doubts, folks? I think the chat box is open. You can sort of let me know if there are any doubts. This is just a recap. That is why we went really quick over a few topics. All these topics that we did a little bit of a recap on, is been discussed in the fifth session of this series. This is the sixth session. So the previous session was more about trends, identifying trends, how are they formed, so on and so forth. If there are no doubts, we can sort of move on. Right? I don't see anything in the chat box. All right. Let's move on and talk about a new topic, which is classification of assets. Let's talk about classification of assets. Now, there are different kinds of assets in the markets, right? We are not only looking for stock market, we are not only looking for FX of foreign markets. The different assets are stocks, commodities, Forex, crypto. These are the four different kinds of assets. Well, there are more assets as well, but these are the four main types of assets that we all know, that we are all aware about. Let's start with the most basic assets. Let's start with the stock. What is a stock market? Very simple. Stocks are nothing but buying and selling of shares, buying and selling of buying and selling shares of a company. This is a stock market, right? Now, when you look at a stock market, let's bring this down. Let's focus on stocks. When you look at stock market, you could sort of trade and invest in the market. You could do both. But both of these things are done very separately, as trading and investment is very separate. They're very different. They're poles apart from each other. So when you talk about trading and investing, let's talk about investing. Let's first talk about investment and then we move on to trading. When we talk about investment, investment can be done in two types again. One is buying individual stocks, means you buy Apple, Meta, Nvidia, uh, uh, Google, so on and so forth, right? So you're basically investing in the company share by share, meaning you have individual stocks, which is you just directly go and buy Apple, Meta, Nvidia, so on and so forth. The next way is buying ETFs. What are ETFs? Let me create a different window for this. What are ETFs? ETFs are nothing but exchange traded funds. What are exchange traded funds? Basket of stocks. Basket of stocks, right? Now, when you buy an ETF, you have to look at multiple factors, meaning what is this ETF do? How many stocks are there in an ETF? Let's look at a very basic example. S&P 500. S&P 500 is an index. S&P 500 tracks the performance of the top 500 companies in the stock market. So when we look at S&P 500, what happens is it is an index. We cannot trade an index, right? We cannot invest in an index. We cannot trade a particular index. So we have to go from a point of buying individual stocks in an index, which means you can either buy all the 500 companies in an index individually, or you could buy top 10 companies in that particular index. The second option is ETF, right? Each and every index has its own ETF. Let's talk about S&P 500. S&P 500 has an ETF called SPDR ETF, right? When you invest in this ETF, what happens? When you invest in an ETF, let's say your investment is $1,000 in the ETF. Let's say you want to invest $1,000 in the ETF. What happens? The $1,000 is sort of divided amongst all the 500 companies. The $1,000 is invested or is divided amongst all the companies in the ETF. It does not mean that it is divided equally. It is divided on the weightage of the stock in that particular ETF. Meaning, let's say if let's look at top five stocks, right? Let's say we have Google, Apple, Tesla, Meta, right? One, two, three, four, five. Correct. We have five stocks. Let's say Nvidia holds 8% of S&P 500. Google hold, let's say 5%. Uh, Google holds about, let's say, 7%. Apple holds about 6.5%, 6% for Tesla, and 5% for Meta. Now, when you look at your investment, Nvidia has the highest weightage, right? What does it mean? When Nvidia has the highest weightage, this means that out of $1,000, 8% goes in Nvidia, which means $80 will go in Nvidia. This is what it means. And then the rest of it is divided based on the percentage of the weightage of the stock market in that particular index. And ETFs are usually for long term. It is not something that you could hold it for maybe a month or two and then exit. No. We also have to look at the capital gain tax as well, long-term and short-term capital gain tax. We also have to be very careful about that as well. So whenever you invest in an ETF, this is more for long-term investments. It is not something for short-term where you invest for a couple of months or you invest for maybe a year or two and you get out of it. No, you keep an ETF for at least 5 years, 10 years down the line because it is going to keep compounding. As long as you hold, it's going to keep on compounding, and that's when you take out your money after, let's say, 10 years, 15 years down the line, right? So ETF is for long term, and again, uh, then you buy individual stocks where you could sort of invest even for 6 months, you invest for a year. That is more on short-term investments where you just invest anything less than a year are your short-term investments. Anything over a year are long-term investments. So the taxation, when you talk about the taxation, when you talk about the taxation, short-term capital gain tax is sitting at 39.60%, which is less than a year. This is the maximum, by the way. This is not something, this is the maximum. And long-term capital gain, the tax is sitting at 20%, more than a year, right? Uh, More than a year. So your short-term and long-term capital gain tax applies depending on the duration of the assets that you're holding. So this is more on, taxation and everything. But back to the topic of ETFs and stocks, these are the ways you could sort of invest in an ETF. Let me take this out so we can discuss about different topics. Okay, let's talk about trading. Let's talk about trading in stocks. Buying individual stocks and selling them within within a few days to few months, right? This is more into trading. So when you trade a particular stock, it's more on buying an individual stock, you're holding it for some time, you're taking advantage of the short price movement and then getting out of the markets. There is something called as a leverage component. When you talk about leverage, we discussed this in the previous session as well, but just to give you a quick idea of leverage, leverage is nothing but buying power. Meaning if you have a trading capital of, let's say, $1,000, the broker can give you a leverage of up to 4 times, which means your buying power is now at $4,000. You can buy any asset worth 4,000 US dollars. This is what it means. So the leverage for stocks, the allowed leverage for stocks sits at 4 times, which means 4 times your trading capital. If you have $10,000, you multiply it by 4, you have $40,000. You can buy and sell assets worth up to $40,000 based on your investment. If you have $1,000 multiplied by 4, $4,000, so on and so forth. This is the allowed leverage by the regulation, which is the SEC regulation, United States Securities and Exchange Commission. This is your allowed leverage by the main regulatory body of the US, which is SEC. Any doubts with stocks? If not, we can move on. Let's give it a minute. If there's any doubts, please let me know. Shoot your questions in the chat box. All right, I don't see any doubts. I think we can move on. Perfect. Let's move on. Let's look at the next asset, which is commodities, trading in the commodities. What is commodities? Commodities are metals like gold, silver, aluminum, zinc, copper, so on and so forth, right? Etc. Oil. Let's not forget oil as well. Oil is a very important commodity. It does not fall under metal, but it is a commodity. It falls under commodities. It is not a metal. Gold is called as safe haven. Also, hedge against inflation. I have received a message, Mr. Bilal, that everyone chat is disabled. Can we please enable the chat for everybody?
Yes,
Uh,
let me look at it.
sure. Thanks, Mr. Altaf, for bringing this to our notice. I was not aware that the chat has been disabled. Let me know when. Okay,
Yes, I
it is
guess
okay now.
it's, yeah,
All right. Thanks a lot, Mr. Bilal. Thanks a lot, Mr. Altaf, for
you're
bringing this
welcome.
to our
Thanks,
notice.
Mr. Uthar.
All right. Any doubts, folks? I'm sorry, but let's give it one more minute. If there are any questions related to stocks, and then we can move on to commodities. Just the chat was disabled. Let's give it another minute so we can take the questions as well as we move forward. All right. I don't see any questions. We can move forward. All right. Let's look at commodities, right? Commodities are metals, gold, silver, copper, aluminum, zinc, so on and so forth. Gold is called as safe haven, which is hedge against inflation. What is oil called as? Oil is called as liquid gold. Two sessions ago, I think in the 4 sessions we discussed about the difference between US dollar, oil, gold, and stocks, how they sort of move, and what is the correlation between them. If US dollar goes up, what happens to all the other currencies, what happens to gold, what happens to oil, so on and so forth. If anybody would like to sort of look at the distinguish or sort of look at the difference, it is available. The topic is discussed in session number 4. So gold is called a safe haven, oil is called as liquid gold. Now you could sort of trade and invest in this particular commodity. The regulatory body is CFTC, which is Commodities and Futures Trading Commission. This is the regulation or regulatory body uh, of the US for commodities, Forex, and crypto, right? So anything that happens in commodities, Forex, and crypto, everything goes under CFTC, whereas anything that happens in stocks, that goes under SEC, Securities and Exchange Commission. So these are two different entities, or these are two different regulatory body, but they are for the US itself. So whenever you decide a broker for stocks, commodities, futures, Forex, crypto, anything, make sure that the broker is regulated by SEC or either by CFTC to sort of be under the legal regulation so you could trade transparent. There always has to be a transparency in the markets, right? So make sure that you are under the regulation. Let's talk about commodities, trade and invest. When you look at commodities, you could trade gold day to day. You could sort of buy and sell short term. You could buy and sell short term. Or when you invest, you could sort of invest long term in gold. All right. That means compounding. And how does compounding happen? Buying an asset in periods. That could be in quarterly basis. You can buy commodities quarterly. You could buy commodities monthly. You could buy it yearly, depending on your sort of, how would you like to diversify your investment. You could, again, it's from person to person. Some of them invest in gold every month. They buy gold every month. Some of them invest or they buy gold when during a special occasion. Some of them sort of invest every 6 months. Some of them do it yearly. So it depends on how would they like to invest. So gold is a very good asset, by the way, because if you look at the trajectory of gold in 1 year, in the year of 2025, from Jan to November, gold has been up 66.6% for the year. Gold has been up 66.6% for the year, which is a huge rally to the upside. And now the gold is currently fluctuating between 4,000 USD to, or we should say somewhere about 3,900 USD to 4,000 US dollar per ounce. This is where gold is currently fluctuating. So is this a good time to sort of buy? Of course, it's a commodity, right? It's a commodity that sort of stays with you for long enough. Uh, you could buy gold digital, you can buy it, you can buy physical gold, but I always advise to buy digital gold. The reason why is you sort of eliminate a lot of charges, from making charges to the commission that you pay to the jeweler shop. So you do sort of bypass a lot of commission. So I personally like to sort of invest in gold, and it is always through a broker. So I do invest a lot in commodities because of the movement, or because of the way they move. It has exponential returns when it comes to portfolio. When it comes to sort of, if you look at your portfolio, so on and so forth. So when you look at the leverage, now leverage is only for trading, by the way. Leverage is not for investments. Leverage is only for trading. So when you look at leverage, gold offers leverage up to 10 to 1 or 20 to 1, depending on the broker and the regulation. So this is the regulation bracket this is the leverage bracket that you will be, meaning if your trading capital is $1,000, leverage is 10 to 1, your buying power sits at 10,000 US dollars. You can buy and sell anything worth up to $10,000 using the leverage. And if the leverage is 20 to 1, meaning your buying power increases to $20,000, trading capital into the leverage, that's your buying power, just to give you an idea. So this is what, this is how you could sort of invest in gold, uh, commodities, silver, aluminum. One more thing we can look at one more thing is let me write it down here. Gold and silver are positively correlated. Now, what is the meaning of positive correlation? If gold goes up, silver goes up as well. This is the meaning of positive correlation. If gold goes up, silver will go up as well. The current price of gold is, let's assume, 3,900 US dollar per ounce, where silver is sitting at somewhere about 40, 50, let's say 50 USD per ounce. There is a huge difference in price. There's a huge difference in price. So let's say if somebody feels that gold is, uh, very saturated, it is sort of, this is not that you want to pay for gold, 3,900 US dollars per ounce. You could sort of also go with silver. That could be a second option for you to invest as well in silver, because silver and gold both go hand in hand, meaning if silver goes up, gold also goes up. This is what it means. Let's move on to the next topic. I hope this is clear. Let me know if there are any doubts. Let's move on to crypto. FX, we could look at Forex in the last, because again, that is something that we have been discussing for the past 5 to 6 sessions. Let's look at crypto. Crypto markets, crypto is nothing but cryptocurrency like BTC, Ethereum, XRP, Solana. These are the top cryptocurrencies. These are the top four cryptocurrencies, 3 to 4 cryptocurrencies where Bitcoin is priced at 89,000 US dollars per Bitcoin right now. And crypto markets are dominated by Bitcoin. Crypto markets are dominated by Bitcoin. Uh, and also it sits at 89,000 as of now, where the all-time high for Bitcoin has been $125,000. This is the all-time high for Bitcoin, 125,000 US dollars for one Bitcoin. And now it is sitting at a bargain of 89,000 US dollars. Uh, the market is led by Bitcoin. So if Bitcoin rises, Ethereum goes up, XRP goes up, Solana goes up as well. Uh, Again, it's a cycle. So it's a cycle of supply and demand. It is a cycle of fundamentals. So there is a lot when we talk about cryptocurrency. Uh, Crypto markets are 24 hours, 7 days a week. So they're 24/7 markets. So they move 24/7 even over the weekends. Crypto markets never sleep. Let's discuss about exchanges, different types of exchanges in crypto markets. There are two kinds of exchanges. One is called a centralized exchange. The other one is called as decentralized exchange. And the other one is called a decentralized exchange. When you look at the centralized exchange and a decentralized exchange, what is the difference between a centralized and a decentralized exchange is a centralized exchange is regulated, a decentralized exchange is unregulated, right? Transactions and withdrawals and deposits happen in USD, whereas in decentralized, Withdrawals and deposits happen in USDT. What is USDT? USDT is a stable coin called as Tether, meaning 1 USD equals to 1 USDT. This is what it means. So it's a stable coin. It's Tether, right? For every US dollar, you have 1 US dollar, which means for every 1,000 USD, you have 1,000 USDT. Stablecoin is specifically created for decentralized markets who would like to trade meme coins, like meme coins like Pengu, uh, Dogecoin, so on and so forth, right? Anybody who would like to trade like meme coins, which is a coin that can go from, it can gain from, let's say, 1% to 100% within a month, or 1% to, let's say, 500% within a month. And there is high leverage. Leverage is more than 100x, right? There is high leverage as well. So there's high leverage in decentralized markets, meaning there is higher risk as well. Higher the leverage, higher the risk. Whereas regulated markets, you could trade most of the currencies, right? You could trade like most of the cryptocurrencies, meaning you could trade Bitcoin, you could trade XRP, you could trade Solana, so on and so forth. And let's say you could trade Bitcoin to USDT, whereas in decentralized markets, it is Bitcoin USDT. This is the difference. More or less, the markets are the same. There is no difference. The only difference is that you have higher leverage in unregulated markets under decentralized markets. And under the centralized markets, you have lower leverage. The leverage for crypto is max to max 20 times. When you talk about the centralized exchange, depends on the broker to broker as well. Uh, when you invest, you can invest in coins. When you invest, there is no leverage, as investment is without leverage. Trading is with leverage, right? So depending on your investment, if you would like to invest, if you would like to trade, you could sort of play around in both the markets depending on your risk. So this is a little bit of a brief introduction of crypto markets as well. Let's look at the last market, Forex markets. This is what everybody is interested in. What are Forex markets? It's currency markets, exchanging one currency against the other currency. It's always an exchange of currencies, one currency against the other currency. It's a 24 hours, 5 days a week markets. Market is shut on Saturdays and Sundays. It consists of three main sessions: Asian session, European session, and New York session, also called as New York markets. Um, the market is, of course, dominated by US dollar, USD. This is how the markets are sort of dominated. So there are different types of currency pairs. There are a total of 180 currency pairs, which are diversified or classified in majors, minors, and exotics. We have discussed this in the first session. Gone over uh, we have gone over how the Forex markets work, the basics of Forex. Different sessions, we have sort of given a very detailed introduction into Forex markets in the first session. This is just a quick recap of the first session, more or less, when we talk about Forex markets. 180 pairs divided into majors, minors, and exotics. The major currencies the major currencies are USD, Japanese yen, Canadian dollar, euro, pound, Australian dollar, New Zealand dollars. 1, 2, 3, 4, 5, 6, 7, and Swiss franc. Sorry, forgot to add Swiss franc as well, CHF. These are the 8 major currencies and has the highest volume. All these 8 major currencies have the highest volume, and you could sort of mix and match one currency with the other currency. pairs as well. Now, the Forex markets are very transparent and they are the largest financial market with a daily transaction volume of over 7 trillion US dollars. So anybody who's getting into the Forex markets, you're in for a big money. The reason being it is the biggest market in the world. And of course, the most transparent and the most stable as well compared to all the markets. Now, some of them might ask that which market is better? All the markets are good. It's not that stock market is better than Forex or Forex is better than crypto, crypto is better than the commodity market. Depending on your goal, what is your goal? What is your end goal? Would you like to day trade? If you want to day trade, get into commodities and Forex. If you want to invest for long term, if you want to create wealth, get into stock market, right? If you want to trade a riskier asset, get into crypto, right? If you want to invest in riskier asset, get into crypto markets again. But if you want something stable, right? Because can a currency vanish out of thin air or can a currency vanish like can euro vanish? Euro cannot vanish. Europe cannot say, European Union cannot say that, hey, we are shutting down the euro currency. That can never happen, right? But can a company like, just giving you an example, can a company like Apple, Meta, Tesla come to a point saying that we are not generating enough revenue? We need to shut down the company. We need to liquidate. We need to sort of liquidate the whole company, meaning sell the or file for a bankruptcy. Can that happen? Certainly, right? So, which is much more stable when you compare a currency versus to a company? Of course, a currency is much more stable, but you cannot invest in a currency because the difference is always in a few cents. It can never be, of course, it can go to a dollar two as well, but the difference is always in a few cents. It's very difficult to make or create wealth investing in a currency. That is why if you want to invest, always go with with the commodity markets, with the stock market. That is for wealth creation. For trading, come over to Forex. Forex is really good for trading. Crypto is good as well. High risk, high reward. Commodities is good as well. Stable markets to day trade as well, right? So it all depends on which markets would you like to focus on. So I'm going to leave that to you, and then you could sort of come back and say, hey, this is the market that you have selected based on your requirements. So looking forward to that. Let's look at, I hope this is clear. Sorry, folks, any doubts before we move on to the next topic? Let's give it a minute. If there are any doubts, feel free to drop down in the chat box. It's open for everybody. Right, I don't see any questions. All right, let's move on to the next topic. The next topic is trading psychology. What is trading psychology? Trading psychology is how are your emotions when you take a trade, before a trade, and after a trade, right? Now, why 95% of the people lose money in trading is not because of having a bad strategy, having a bad trading strategy, right? It's not because of this. It's because of two reasons. One is risk management, and the other reason is emotions. This is a very important topic to focus on, actually. This would solve 95% of your issues when you're trading and can sort of put you into the profitability bracket of trading. And this is where most people lack risk management and emotions. Let's talk about risk management, right? A lot of people like to take 10% risk per trade. They would like to take 15%. They would like to put their whole capital at risk when taking one trade. Now, when you take a particular trade, let's say when I take a particular trade, I sort of do not risk more than 2%. Oops, it went to 12%, 2% of my entire capital. Meaning my trading, let's say trading balance, let's say balance is let's say 10,000 US dollars. My risk is going to be only 2%, which is about 200 US dollars per trade. What am I doing? I'm saving money for the next trade. So even if this trade goes against my direction, I still have 9,800 US dollars to play around with, right? Meaning I'm not risking my entire capital on one trade, because if the trade does not go in my favor, I'm going to lose the entire $10,000, right? This is why a lot of people fail, is because greediness, because they are very greedy in the markets, right? If the markets are giving them 4% profit, 3% profit, they want to aim for even higher profit, 6%, 8%, 10%, right? That can happen, that can potentially happen, but trading is always a marathon. When you look at a trading, it is a marathon and not a sprint, right? So trading is more, people look trading as gambling, but it is more of a business, right? It is more of a business. So when you take a loss, when you take a loss in trading, don't look at it in a way that you have lost money. Look at it in a way that it is an expense to the business, because every business has an expense, right? To run a business, you have to make expense in the business. So each and every business does have an expense. So when you look at trading, look at it in terms of an expense, is not in terms of a loss. Risk management is a huge part of trading. The reason why, define your risk. Define your risk, meaning define your risk as to how much money are you willing to risk in a month, or how much money are you willing to lose, which is not going to impact your day-to-day life. Let's say you are okay to lose, let's say 10% in a month, right? You're okay to risk 10% in a month, not in a day, in a month, right? So you sort of have to limit your trades as well. You have to limit your trades because you do not want to pay a lot of brokerage fee. Each and every trade you place, you have to pay a certain brokerage amount to the broker that adds up at the end of the month as well, right? So you have to keep a track of that as well. Brokerage fee, right? It adds up at the end of the month. So you have to define your risk. How much are you willing to risk in a month, right? That this is going to be a fixed risk. And look at it in terms of percentage and never in terms of monetary value. When you look at it in terms of monetary value, you're sort of attached to the monetary value now. Meaning, if you say that no, you have to make $200 in a day, you have to make $500 in a day. Now you're forcing your trades. When you force trades, that's when your emotions come in, right? Forcing trades, trading emotionally. Trading emotionally. This is where your emotions come into place, because you are sort of fixed to a point where you have to make the profit. You don't have to make the money. It's not need. It's more of saying that, okay, if the trade goes in my way, I'm okay to lose this much and I'm okay to gain this much, right? And then you are out of the trade, irrespective if you win or you lose, and then move on. So define your risk for the month and then place your trades accordingly. So if your risk is 10% a month, let's say you just want to take 10 trades a month, your risk per trade should only be 1% risk per trade and not more than that, right? Coming to the emotions part of it, make sure you how much, risk how much you are willing to lose, right? Meaning, if you're willing to lose, let's say 2%, your risk should not should not exceed more than 2%. It should be at 2%, right? Because if you risk more than 2%, if you risk, let's say 4%, now your mind says that, no, I want to gain it back. I want to gain 4% back because you lost more than you anticipated how much you could sort of lose, right? So risk management, emotions can go hand in hand. It is always good to master your emotions and risk management to be profitable. Any strategy works in trading. If you look at n number of strategies, you look at breakout retest, what we spoke in the previous sessions, you look at trend following strategies, is what we discussed in the previous sessions as well. What really boils down to is risk management and emotions. This is what it really boils down to. Uh, Yeah, I think anybody would like to add anything to the session in terms of risk management, in terms of trading psychology. I know that I can see that there are a lot of people who I have sort of interacted with in the previous sessions. Anybody, folks, Jet Li, Altaf, you folks wanna add anything to the risk management part of it, emotions, or trading psychology in general? Feel free to add. And this sort of sums up our session with trading psychology. Just to give you a quick uh, conclusion would be to not risk more than how much you can lose, meaning always be under the risk management radar, meaning don't if you can just risk 2%, don't risk 4%. Your risk should be 2%, right? So your emotions are in check. Trading is all about emotions. Your mindset should be very clear when it comes to trading. Your goal should be clear, saying that you want to make, let's say, 5%, 6% in a month. That does not mean you have to force trades, right? You have to take quality trades. So trading is all about quality over quantity. Focus on the quality of your trades, right? When you buy something, when you go and buy something, you first check the quality, right? You first check what is the quality. Is it a good quality? If it's a bad quality, if it's a good quality, you sort of buy a few more of it. Let's say instead of buying one, you can buy two or three, right? So first look at the quality. Don't go over the quantity. Right? The quality will define your success as well in trading. Altaf has said that that is great example. When you lose, you don't lose, you just invest. That is correct. Um, well, I think we can. Okay, I see a few questions. Just a second, by Altaf. Can can we do spot in Forex like we do in crypto? Yes, we could do spot trade. Forex is only spot trading, Mr. Altaf. When you look at Forex, it is spot trading only. Crypto can be done futures as well as spot. Very good question. Second question is, as we study chart patterns, candle patterns, who makes the move to shape a patterns? Who makes the move to shape a pattern? Very good second question as well, Mr. Altaf. The big majority, meaning the big institutions, sort of, make the move in the markets, meaning governments, hedge funds, banks. These are the people who move the market. So it does not matter if there's a pattern forming or if the chart is moving in a certain way. There are only three entities who can really move the markets: is hedge funds, banks, and the governments. These are the only three people who can move the markets. We as retail traders in the markets is nothing but small fish who sort of follow the entire movement of the markets. Answering your third question, why different brokers have different candle in same currency pairs, if you check gold and Noanda compared to IC markets, is because they have different liquidity providers, Mr. Altaf. The- Each and every exchange is different from one another, different buying, different selling. So the candles, the price might be off by a few cents. There won't be a majority of the price difference. But let's say, for example, if I look at Bitcoin USD, right? You see, there are N number. I look for Bitcoin USDT, but there are N number of brokers. There are a lot of brokers like Bitstamp, Coinbase, Index, Crypto. everybody will have different prices. Everybody is going to have different prices, but the prices is going to be off by few cents itself. It is not going to be off by $10, $100, so on and so forth. It is just going to be off by few cents. So thank you for asking such interesting questions. Thank you. Thanks, Jetli, for this feedback. How to check the quality? Quality of the trade depends on how the market moves, Mr. Altaf, right? Very good question. Let me give you an example. How do you check the quality of a trade? Let's look at BTC USD. Let's look at the chart. The quality of a trade is done by doing technical analysis. Is done by doing technical analysis, right? Meaning, does whatever you make a checklist, right? You make a sort of a meaning if the price is moving this way, does it fit your plan, right? If it fits your plan, if you sort of check all the boxes in a checklist, it fits your trading plan, which means it is a high quality trade. If it does not, let's say you have 5 points in your checklist, right? Let's say out of 5 points, only two are being checked. That means this is not a good quality trade according to your checklist. It is a bad trade. So you take the trade off, you don't take the trade. But if there are 3 points being checked out of five, it is a good quality trade, meaning it is better than two, right? So the quality depends on your checklist as to what checklist and how would you like to sort of create the checklist. So it again, checklist is created person to person. So yes, it's a good quality, meaning depending on your checklist. Any other questions, folks? Uh, any other questions? We can take a few questions. We have about a minute or two to go. We can take a few questions. Thanks, Mark. Thanks, KP. Thanks, Jetli, for the thumbs up. Thanks a lot, folks. I think, Mr. Bilal, we can sort of sum the session because I don't see any more
Yes, yes. Thank you so
questions.
much. Thank you so much for your valuable time, Mr. Krishak, and all the knowledge and wisdom you shared with us in all 6 sessions. And thank you so much for all the participants for involving their time and giving us the opportunity to share all the knowledge. And we hope we all learn a lot from this and we'll go ahead and make some money now.
Thanks, Mr. Bilal. Just before we close the session, one quick question to answer. Do you continue advanced classes in the future? Hope so. I think we can sort of stay in touch, and
Yes, of course.
we will be updating if there are any more future sessions. But this was the last session for the series 6 of 6. Thank you, everybody, for staying till the end. And looking forward to seeing you all soon in the future sessions. Thanks a lot, folks. Thanks, Mr. Bilal.
Yes. Thank you. Thank you once again. Thank you all. Bye for
Thanks.
now.